You just totaled your 6-month-old car, the one you paid $35,000 for. And the insurance company just sent you a check for $20,000. You call your agent, confused, and they say that's the actual cash value. But you still owe $28,000 on the loan. So now you're $8,000 underwater on a car sitting in a junkyard somewhere. And by the end of this video, I'm going to show you exactly how this happens to thousands of people every single year, why almost nobody warns you, and the one question you need to ask before you sign any auto loan paperwork ever again. Let's talk about the biggest lie in car insurance: full coverage. It sounds bulletproof, right? Like no matter what happens, you're completely protected. That's not what it means. Not even close. Full coverage typically means two things: liability insurance, which covers damage you cause to other people and their property, and comprehensive plus collision, which covers damage to your car from accidents, theft, weather, that kind of thing. But here's what full coverage does not cover: the difference between what your car is actually worth and what you still owe on it. And that difference on a new car? It can be massive. Here's the thing about new cars that nobody wants to admit. The average new vehicle loses about 20% of its value in the first year. 20%. Gone. In 12 months. And some models drop even faster than that. So let's do the math on that $35,000 car. You drive it off the lot, and basically immediately it's worth maybe $28,000. Fast forward 6 months, you're looking at around $23,000 or $24,000, depending on the make, the mileage, the condition. But your loan doesn't shrink nearly that fast. When you finance a car, especially with a small down payment or a long loan term, your loan balance stays high while the car's value just drops. This creates what's called being upside down or underwater on your loan. It means you owe more than the car is actually worth. And if you're sitting there thinking, well, that's fine, I have full coverage, that's exactly where the $15,000 gap comes from. Insurance companies do not pay off your loan when they total your car. Let me say that again. Insurance companies do not pay off your loan. They pay what's called the actual cash value, ACV for short. That's industry speak for what your car was worth on the open market the second before the accident. Not what you paid for it, not what you owe on it, what it's worth. So let's run those numbers again. You bought a car for $35,000. 6 months later, it's worth maybe $20,000. You total it. Insurance cuts you a check for $20,000. But you still owe the bank $28,000. You hand that $20,000 check to the lender, and you still owe $8,000. On a car you can't even drive anymore. And now you get to figure out how to buy your next car while still making payments on the old one. Fun, right? This exact scenario plays out for thousands of people every single year. And most of them never saw it coming because nobody explained the rules of the game, not the insurance agent who sold them full coverage and made it sound airtight, not the dealership that got them laser-focused on the monthly payment instead of the total cost. And definitely not the bank that was perfectly happy to approve a loan for more than the collateral was worth. Everyone in this chain gets paid. You're the one holding the bag. So what's the fix? It's called gap insurance, guaranteed asset protection. And it does exactly what it sounds like. It covers the gap between what your regular insurance pays out and what you actually owe on the loan. In that scenario we just walked through, gap insurance would have paid off the remaining $8,000. You'd walk away owing nothing. Clean slate. Now here's where it gets frustrating. Gap insurance is available at most dealerships, but dealers often charge somewhere between $400 and $700 for it. And they usually roll it right into your loan, so now you're paying interest on your gap insurance too. And that's if they even bring it up. Many salespeople skip right past it because it's an uncomfortable conversation. Nobody wants to say, hey, congrats on the new ride, you might total it and go bankrupt next week. Doesn't exactly kill the vibe in the finance office. But here's what most people never find out. You can get gap insurance through your regular auto insurance company, often for a fraction of what the dealer charges. We're talking maybe $5 to $15 a month added to your existing policy. Same coverage, same protection, way less money, $5 to $15 a month to avoid an $8,000 financial emergency. That's the math. So how do you know if you actually need gap insurance? Run through this checklist. 1. You put less than 20% down on the car. 2. Your loan term is 60 months or longer. 3. You're leasing the vehicle. 4. You rolled negative equity from a previous car loan into this new one. 5. You bought a make or model that depreciates faster than average. If even 2 of those apply to your situation, you probably need gap coverage. And if you're still not sure, ask yourself this one question. If my car got totaled tomorrow, could I pay off the remaining loan balance with whatever the insurance company would give me? If the honest answer is no, you need gap insurance. Now here's something else that catches people off guard. Gap insurance isn't a forever thing. You only need it while you're underwater on the loan. Once you've paid the balance down to where you could sell the car and cover what you owe, you can drop the gap coverage and stop paying for it. For most people on a standard auto loan, that's somewhere around the 2 to 3 year mark. You can even call your insurance company and ask them to remove it once you're no longer upside down. Keep more of your money. And one more thing before we wrap up. Not all gap insurance policies are created equal. Some cover your deductible in addition to the loan gap. Some don't. Some have caps on how much they'll pay out. Some only cover certain types of total losses. So if you're shopping for gap coverage, actually read the details or ask your agent specifically what's included and what's excluded. The cheapest option on paper isn't always the best option when you actually need to use it. All right, let's tie all of this together. Full coverage does not mean what most people think it means. It covers your car's market value, not your loan balance. New cars depreciate aggressively, especially in that first year, and that creates a gap that can leave you thousands of dollars in debt if the car gets totaled. Gap insurance closes that gap, usually for less than $15 a month if you go through your insurance company instead of the dealership. And you only need it until you're no longer upside down on the loan. This is one of those things that seems obvious once someone actually explains it to you. But nobody explains it. Not in school, not at the dealership, not when you're signing the loan docs at 8% interest at 10 p.m. on a Tuesday. The financial industry profits enormously from people not understanding the fine print. And the single best thing you can do for yourself is start asking questions before you sign anything. Ask about gap coverage. Ask about actual cash value. Ask what happens if the worst-case scenario becomes real. If the person across the table can't give you a straight answer, that tells you everything you need to know. If this kind of breakdown is useful, there's plenty more where it came from. This channel exists to decode the money stuff that actually impacts your life. No jargon, no nonsense. Subscribe if you want to keep catching the things that slip through the cracks.